Welcome. This is the introduction to financial statements. We're going to look at the balance sheet, the income statement, the cash flow statement, and then I'm going to cycle quickly through an appendix, just showing you a bit. Now, the balance sheet provides or presents a company from whose point of view? Is it the general manager or the CEO? Or is it perhaps the owner? Many of us think of it that way, but actually, it's presenting it from the point of view of the company itself. I think that's the best or easiest way to look at it. So the company as its own entity. Well, I'll talk about it just now. So what does a balance sheet show? As you may see, you may have learned, it's a T, and on the left side we have assets. That's what a company owns. So it's the stuff that the company owns is on this side. And then we have the liabilities and equity, which from the company's point of view is what the company owes. Specifically, in terms of equity, from the point of view of the company, equity is what's left of the assets after all of the other liabilities are paid. So equity from the company's point of view is a liability to the owners. So that's why the equity is on the liability side of the balance sheet. Now, the balance sheet is almost always set up from the most liquid to the least liquid of assets and on the liability side. So in most beginning courses, the main assets, current assets, are going to be cash, accounts receivable, and inventory. And then we have the section called officially non-current assets, or often you'll hear the expression fixed assets. Those are usually plant and equipment and machinery, for example, and land. Now, on the liability side, we start off with current liabilities. The most common ones that you'll run into are accounts payable and notes payable. Then we go to the non-current or long-term liabilities. The most common there is long-term debt. And then we get into the equity section, which is in two parts. One is the paid-in capital and the retained earnings. As you look into financial accounting, the definitions of each of these should be known to you or will be known to you. Of course, there are many other types of balance sheet items, but these are the main ones, especially for introductory courses. So that's the general overview for the balance sheet. Income statement. What does an income statement show? Well, an income statement shows, generally speaking, two things. One is the amounts earned, or revenues, and the amounts spent, or costs. Now, the income statement structures the revenues and costs according to their type. It may also be presented in a single-step format or a multiple-step format. Here we have an example of a single-step income statement. You'll have the company name here, the financial statement, which in this case is an income statement, sometimes called profit and loss statement, and for the period that it covers. Here you'll see you have revenues, and then you have expenses, and then you have the net income at the end. So a single-step income statement uses just one subtraction. Here you're summing up all the revenues, and then you have 730,000. Here you have all the expenses coming up to 752, and the difference here is the net income. So you only have one subtraction. And so all the revenues and all the expenses are subtotaled. Now, in this case of a multi-step or multiple-step income statement, you'll notice it uses more than one subtraction. There's an operating section and a non-operating section, and almost always you'll run into the gross profit and the operating profit calculated in the operating section. So here we have an example, net sales, and then it goes into quite a bit of detail to get the cost of goods sold, resulting in the gross profit. Then you have other expenses, various expenses here. That gives you the operating expenses, so you subtract that from our gross profit, and that gives us our operating income. Then you have other income and expenses, so that's the non-operating section. And then at the end, we have the net income again. This is the multiple step. So now we come to the cash flow statement. The cash flow statement breaks down the sources and uses of cash, which means the inflows and the outflows of cash, into three areas. One is the operating activities. Basically, those are the main revenue producing activities of the entity or the company that are not involved with investing or financing. Investing activities have to do with the acquisition and disposal of long-term assets and also other investments. And finally, financing activities are those that have to do with the equity and debt funding structure of the company. Now, in a bit of more detail, interest and dividends received and paid may be classified as operating, investing, or financing cash flows. And cash flows arising from taxes on income are normally classified as operating unless it can be specifically identified with financing or investing activities. Please note I am focusing this presentation more on International Financial Reporting Standards or IAS, IFRS, than on US GAAP. Now, I'm going to move quickly into an appendix. I'm just going to talk about IAS and IFRS to give you an overview of what it looks like. As you can see, there are a lot of specific standards for all kinds of aspects of accounting. So here we have the presentation of financial statements, which is IAS 1. And for the balance sheet, it speaks about how current assets and all of the other assets and liabilities are to be shown and identified and defined. You can see the various line items that are to be included. Talks about the format of the balance sheet and also issues regarding share capital and reserves. The income statement speaks also about how you look at the income statement as well. There's the comprehensive income, which includes other movements that are not included in the profit and loss or the normal income statement. And as you can see, there are some parts that are items that are recognized outside of the usual profit or loss or the income statement that we see that gets included in the comprehensive income. The last statement, which is a statement of changes in equity, I didn't include in the main presentation. However, it is one of the four basic statements, but for an introductory accounting presentation, this would be going a bit far. I just wanted to point out that you have also a clear definitions of what is to be included in the statement of changes in equity. And here you see disclosure requirements. Finally, we have these, when we talk about the cash flows, there are two methods. There's a direct method and indirect method. The direct method talks about directly what are the cash flows, the cash receipts and payments in the operating section. The financing and the investment sections are pretty much similar, but the indirect method, as you'll see, looks a bit different, and this is actually more commonly seen in financial statements where you're indirectly deriving the net cash from operating activities. I hope that was a good introduction for you, and thank you for your attention.